What can a 1970s investing book teach us about today's stock market? Well, a lot, it turns out. This month's book is Supermoney by Adam Smith. Not the Adam Smith who wrote The Wealth of Nations. This Adam Smith is a pseudonym used by George Goodman. Supermoney offers a fascinating snapshot into the 1960s and early 1970s stock market go-go days. More specifically, it focuses on investor behavior during periods of euphoria. And it's surprisingly relevant today because it captures timeless patterns that were certainly not unique to the 1970s. So let's take a moment to review some of those timeless themes. First up is the illusion of new eras, also known as this time is different. Second, we have charisma driving capital. This is when fund managers become celebrities and people invest in the person more so than the strategy. Third is complexity being mistaken for sophistication. This is when complex sounding strategies and jargon can give investors a false sense of confidence, even when they don't fully understand what they own. Fourth is performance chasing, or pouring money into the best performing investments right before the momentum reverses. And last is the fragility of market narratives. When narratives collapse, stock prices can fall a long way before they find a floor supported by good old-fashioned fundamentals. For the key takeaway, let's take a deeper dive into the illusion of new eras theme. We should all know by now to be skeptical when we hear the words, "this time is different," and yet investors still go along for the ride, suspending disbelief. In Supermoney, it was the Nifty 50 growth stocks, companies thought to be so dominant that traditional valuation metrics just didn't matter and that they could be bought at any price because of their expected long-term dominance. I kind of feel like I've heard this argument used recently. Now, to refresh your memory, the Nifty 50 included companies like McDonald's, Coca-Cola, Disney, Xerox, and IBM, just to name a handful. Many of them quadrupled or more in price from the late 1960s to 1973, and then were cut in half or worse over the next 2 years. Every cycle has its version of can't miss or can't lose investments, whether it's tech in the late 1990s or maybe AI today. The lesson is that the narratives change, but that human behavior doesn't. I think the natural question here is, are today's high-flying stocks at extreme valuation levels that are disconnected from fundamentals? And the only thing I can say with certainty is that the valuations are actually not as bonkers as we have seen in recent history. This JP Morgan chart goes back to 1996 and shows the blended valuation multiple for the top 10 largest US companies. That's the green line. And it is nowhere near the levels it was before the dot-com crash or even the higher levels over the last 6 to 7 years. So while stock market prices sure feel a little stretched and maybe a little precarious, we've seen much worse. So I guess we got that going for us. For those who know me, you know this book is right up my alley. Really fun read. It was published in the 1970s, and yet it covers so many fads and trends that are playing out in the current investment market that younger investors might think are new. They're not. There's nothing new under the sun. Now, as far as a recommendation goes, Supermoney is good. Adam Smith's earlier work, The Money Game, is great. Highly, highly recommend this book. All right, one book, one main takeaway. Next month's book is Die with Zero. See you in September.